Hello, friends. Wishes for the upcoming festive season to all of you and your family. India is in the midst of growing very fast. The last 4 5 years have been great for the Indian economy and for all Indian equity investors. We are on track to be a $4 trillion economy by 2025, which would mean that in 78 years, India has reached $4 trillion as far as economy is concerned. All the major international organizations have been guiding India's GDP growth to be 7% plus on real basis as we move forward. If you just take that and even account for a small depreciation of Indian rupee, we are very confident that this $4 trillion economy is headed to becoming an $8 trillion economy over the next 8 years. What this means is that the wealth which we have created over the last 78 years, the same wealth is going to be created over the next 8 years. And I think that makes it a very interesting place to invest in. Why are we so confident? We call it the 4D effect. So the first D is obviously democracy. We have seen in the world after Russia that foreign investors have lost almost 100% of what they invested because it was an autocracy. The same concerns come from China, and maybe that is one of the reasons why Chinese valuations are lower than India. In all this, India stands out as one of the largest democracies in the world with the most stable government and leadership. After the current elections, we have the same government which will be there in power for 15 years with the same leader, our Honorable Prime Minister, Mr. Modi. And what this means is that the whole focus on reforms, continuation of growth, fiscal prudence, which was also very clearly highlighted in the budget which was announced last month, will continue. And all this means that India will emerge as one of the very, very stable economies, both from a political perspective as well as the growth perspective. The second D is the demographics. India is one of the youngest economies in the world. As we speak, the median age of India is less than 30 years. And even after 20 years, it is expected that the median age would be roughly around 35 years, which would make India one of the youngest economies in the world. More importantly, as we speak, 400 million Indians can afford some bonds. This number will significantly increase over the next 10 years to almost a billion people. Now, the 600 million people who will be the new entrants in this want category and who will spend on consumption is almost equal to the total population of Europe as well as US. And I think that gives this economy very strong legs. The third D is the domestic demand. We all know that after COVID, the world was struggling. It was almost in recession. However, Indian economy continued to grow upwards of 6-7%. And that is largely because most of the Indian economy is dependent on domestic consumption. And I think we all know that when the world was struggling, we were celebrating weddings and birthdays and anniversaries like never before. Flights were full, hotels were full. And that is the power of the domestic Indian economy. And that also gives us the confidence that the 7% plus growth, which is expected, seems to be for real. The last D is the digital dividend. We are an economy which has suffered because of lack of infrastructure. Even there is a huge progress going on. But the digital dividend through the UPI, through the mobile phones, through connectivity, better compliance, all the subsidies being given online has meant that tax collections are also upwards of 20%, which is helping the fiscal deficit as well as providing the resources which is needed for faster growth. So because of all these 4Ds, we are very confident that the Indian economy is going to move from 4 trillion to 8 trillion. Coming to the markets, I think markets have been phenomenally good for investors last 4 5 years. I think going forward, our view continues to be optimistic. There are always concerns about the valuations. Just to give you a little bit of context, we are trading, as far as Nifty is concerned, around 17 and a half times on an FY26 basis, which is not cheap, but which is not exorbitantly expensive. And given the fact that earnings are expected to grow upwards of 15% for the next 2 years, our view continues to be one of optimism as far as the markets are concerned. The second thing is the world is also stabilizing. I think we have already seen the worst as far as inflation and interest rate is concerned. A couple of countries and regions have already started interest rate cuts, and it is expected that even in the US, interest rates might start getting cut post the elections, which are expected in the next couple of months. Even in India, the G-Sec yields have come down to around 6.85%, and it is expected that the interest rate decline cycle will start. Oil prices have also been pretty soft or stable at around $75 to $80. And being a large importer of crude oil, I think lower oil prices also help. The move towards renewable, the move towards the development as far as hydrogen is also long-term positive for India. And I think that should also ensure that there is stability as far as the Indian economy is concerned. Our fiscal deficit has been brought down below 5%. The target is to bring it down below 4.5%. Current account deficit, which used to be 5% plus, is now below 1%, and that's why Indian rupee has also been pretty stable. So all in all, we have a lot of optimism. Obviously, there are geopolitical risks and small wars going on in the world, which keep on, causing near-term volatility. Recent movement in carry trades and currency are also, some events which lead to volatility. But by and large, because of the strong growth, we continue to be optimistic as far as the Indian economy is concerned. From a market perspective, though, we are positive, as I mentioned earlier, but the returns which we have generated over the last 3-4 years might be difficult to replicate. And therefore, long-term investors should expect moderation in returns. Our base case is low to mid-teen kind of returns with some alpha coming in from stock picking or by investing in broader markets. The other question which keeps on coming out is mid-cap, small cap versus large cap. Yes, mid-cap and small caps have done phenomenally better than large caps. Going forward, we do expect them to do slightly better than large cap, though the alpha which was generated over the last 4-5 years might reduce to some extent. But it is not about mid cap, large cap, or small cap. It is all about buying the right companies with good management at the right price. And as a Bacchus, I think that is what we will focus on, given our investment philosophy and a great reliance on the proprietary meats framework. Thanks a lot.